Recession fears are creeping into the market as investors attempt to understand the administration's ever-changing trade policy and its potential impact on inflation. The market will get its next gauge on the state of the U.S. inflation Wednesday with February's consumer price index. Joining me now, we've got Julia Coronado, who's the MacroPolicy Perspectives founder and president. Thanks so much for taking the time here with us today. Let's just start with your expectations for this next inflation reading that we're set to get this week.
Yeah, I mean, we expect that we're going to see some remaining stickiness, the kind of stickiness we've seen in recent reports. Not quite as bad. We expect some progress in core inflation relative to January, but we're at a 0.3. We get maybe a tick of relief on the annual rate, but really this isn't a report that's going to give a lot of relief to the Fed. We're in a period of beginning of year price resets that tends to keep core inflation a bit elevated in Q1. So we still think we're going to see some of that in the February report. And so that kind of leaves the Fed in the holding pattern it's been in, and just waiting to see how these policies that are very likely going to affect the trajectory of inflation and growth unfold in coming months.
Julia, what does it take, in your view, to get the Fed to really firmly put itself back on the table when it comes to the idea of the Fed put? What does it take for the Fed to come out and be more dovish? We know that the market is pricing in over 80 basis points of cuts so far this year, increasing the chances of a cut in May. How much more pain do we need to see for that cut in May to become a reality, in your view?
I think we need to see more pain. So the Fed is in a very difficult position. The policies being proposed are almost certainly going to lift consumer prices. So they're not going to see the progress that they had expected to see in the near future. That leaves them on the sidelines unless and until the economy really breaks, the labor market really softens decisively. The bar to cutting is a lot higher than it was, say, in the last trade war in 2018, when inflation was running below their target. And so as tariffs disrupted the global manufacturing economy, the Fed could take out a few insurance rate cuts just to make sure that that doesn't infect the U.S. economy. We are not in that position. The Fed is approaching its inflation target from above. Inflation has been sticky in recent months. So it really would be, the next cut is likely to be motivated by labor market weakness. And it has to be, worrisome enough that they're willing to overlook the imminent threat from tariffs on inflation. So they're looking at risks to both sides of their mandates. And I think May feels real early for them to be lowering rates.
Do you think that prompts them or forces them then, if they see more weakening than they're anticipating on the employment situation side, and then perhaps some adverse effects on the inflation side due to tariffs or any policy action, that puts them in a position where they have to make a decision that they weren't prepared to make or forecasted to make coming into this year?
You mean in terms of, could they raise interest rates?
Potentially.
That has been a conversation we've had with some of our clients. I think that's less of a likelihood now that we see the economy really starting to show strains from what I'm calling the uncertainty tax. It's not just around trade policy, but every facet of policy, including Social Security. So there's a lot of elements of uncertainty that both consumers and businesses are facing. That is starting to show through to the soft data and even into the hard data. Again, it's pretty early, but the direction of travel seems clear. Given that trajectory, we've already been below the GDP forecasts you were citing. We came in the year at 1.6, expecting a slowing trajectory on trade wars and restricted immigration. We're getting more earlier than we expected. Really, the wild card here has been the chaos and the DOGE sort of defaults on government contracts and, this payment disruptions and large scale firings that really have injected uncertainty across a range of sectors that really hadn't been expecting that. So given the growth scare, the likelihood of a rate hike seems very low.
And Julia, to that end, I want to bring up a quote we have from the White House yesterday. Is an official saying we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from business and business leaders. So the White House saying, hey, we're hearing from corporate executives that things aren't that bad. And then later on that same day, you hear from Delta Airlines lowering their profit guidance, hearing similar commentary from small businesses in the small business survey this morning, and also from the likes of Verizon. Are we seeing signs of the beginning of a corporate America slowdown in this economy?
Absolutely. What they're doing, you're hearing a lot of sort of damage control and spinning out of the policy officials that have produced this uncertainty. But when we look at measures of business sentiment, when we talk to business executives, when we scrape earnings reports and see what companies are talking about, it is not a growth-friendly environment. And so you can call it detox or whatever you want to, however you want to frame it in a positive light. This is a tough environment for companies to make hiring decisions, to make CapEx decisions, to plan for the future. A lot of the actions we're seeing were not the ones we expected going in. Yes, we expected tariffs on China. We did not expect a trade war with Canada and Mexico. These are our biggest trading partners. This is significant for U.S. businesses. So, and unfortunately, we don't see any clarity in sight. It seems like we're still going after our neighbors, and that's going to, that's starting to affect travel. We hear people canceling plans to come visit the United States. That's going to affect education, students' willingness to come study here. There's a range of sectors that are going to be impacted by this that, again, weren't the ones that we were really focused on starting at the start of the year.
All right, Julia, really wonderful breakdown. Thank you for joining us. We hope you'll come back soon.
My pleasure.